It's been a fantastic 24 hours, but we have the main event now. And I wouldn't normally have to say anything other than how could I have anything, who doesn't know these people sitting here? But this particular panel is being broadcast and additionally over Yahoo, over who knows how many people are going to see it. And so in that spirit, I feel a certain compelling need to introduce the four of you. We have here, on this event of the 10th review, the three heads or chairman or presidents, whatever, of the three major central banks who were there at the time of the crisis. We have in the first row Jean-Claude Trichet, ECB, Mervyn King, Bank of England, and Ben Bernanke, our Federal Reserve. Now you notice there's a fourth person up there. He's also a central banker, but he's a very special one. As one of the people who put this session together, one of the questions we had, I shouldn't tell you guys, who's gonna be able to control these three people on a panel? And we all looked and we said, we know who, Stan Fischer. Now, in addition to being the central banker, he was the Bank of Israel during the crisis, Stan is also Ben Bernanke's thesis advisor, or at least he signed his thesis, okay? And of course, Mervyn spent time at MIT as well, and Jean-Claude, you did in spirit, okay? So Stan Fischer is the moderator, and he's the one who I have great confidence will, if needed, make sure that this is the best we can get. So I won't take any more of this precious time, but to say let's welcome them to the panel, and it's going to be really exciting. Thank you all for coming. This is a historic event in the sense it's being videotaped. Those of you, all of you, were at one time students. Imagine if you were a student 50 or 100 years from now, and you're reading about the crisis as part of this, and you can actually turn on a video and see what went on this afternoon. Anyway, thank you very much. Let's welcome them.
Well, thanks very much. And Bob forgot to mention that when we were students, we shared an office. So there's a lot of slightly illegal relationships going on around here. It's an extraordinary group that we have for our panel. And since there's no basis of choosing fairly, I'm just going to go with the alphabet. And we'll call on Ben Bernanke first, then Mervyn King, and then Jean-Claude Trichet. And you'll have about 8 to 10 minutes for your first intervention. And the question for the first intervention is, well, I'll have to do this. There's a cartoon that I love, I've loved since the 1960s. It's a cartoon of Herblocks of Richard Nixon sitting on his porch in a rocking chair and being asked by a journalist, Mr. President, if you could do it differently, what would you change? And the answer was, next time, no more Mr. Nice Guy. So the question for Ben, Mervyn, and Jean-Claude is, what have you learned from your experience as the head of one of the great central banks? And what would you do differently if you faced a similar challenge today? Ben?
Stan was my thesis advisor, so he's once again offering an exam question. I wanted to talk about the crisis as a panic. I want to distinguish between a financial crisis, which is any big shock to the financial system, a stock market crash, a collapse of the exchange rate, sovereign bond default, versus a panic, which is a generalized run on intermediaries that do maturity transformation, short-term borrowing to finance credit extension. So a panic is a very specific type of crisis. And what I'd like to leave you with is my judgment that in the United States, at least, the panic was the most important thing. And this is, I think, pretty consistent with what Doug Diamond was saying this morning. So in what sense was the panic the most important thing? First, in terms of our ability or lack of ability to forecast the crisis, going back, obviously we saw, people say, well, how could you not see the housing bubble? Well, we saw house prices. We saw that house prices were very high relative to rents. We understood that part. I think our hope was that that would correct in a more gradual way over time, but that was certainly something we saw. We saw the risk premia that Raghu Rajan was talking about. Alan Greenspan, in one of his valedictory speeches, talked about low risk premia and the costs that can be entailed by low risk premia. What we didn't see was the vulnerability of the modern, complex, securities-based financial system to a panic. But in fact, of course, we saw in the crisis, we saw the run on asset-backed commercial paper, we saw a run on money market funds, we saw collateral runs, we saw repo runs, so it was really quite generalized. And I think the conceptual problem there was that in almost all these cases, the short-term liability that was being run was collateralized. So take repo, for example. It's collateralized in that it's backed by generally pretty liquid securities. So our view was that it was unlikely that we would see runs in those collateralized markets. Nevertheless, it turned out that as the crisis worsened and as lenders became worried about the liquidities of secondary markets and their own ability to dispose of financial assets in a timely and efficient way, the easiest thing for them to do was to run. And we saw, again, runs throughout the system. So again, I think the thing that we didn't see coming was the extent of run vulnerability throughout the modern financial system. And again, I would support what Doug Diamond was saying and what Gary Gorton has said, is that in the crisis, look for the short-term liabilities, look for where the run potential is. So that's the first way in which the panic was the most important thing. The second one was in the effects on the economy. So the great financial crisis was followed by the Great Recession. There was an obvious causal relationship there. The crisis, certainly a major contributor to the very serious recession we had in the United States and elsewhere. And there's been some debate about what was the main mechanism. For example, certainly some of the effect just came from the unwind of the housing bubble, the fact that wealth effects of declining house prices, for example. But I would argue, and I'll give you two pieces of evidence in a moment, I would argue that without the panic, without the pervasive panic, we would not have had nearly so bad an economic outcome as we did. I'll give you two pieces of evidence. The first one has to do with the forecast being made by standard macro models before the crisis. Don Cohn and Brian Sack have a nice paper on monetary policy during the crisis, and they show some simulations in real time that were done by the Fed staff and included in the Green Book, which is the briefing book that goes to all the members of the Federal Open Market Committee. And what they showed is that even as late as October of 2008, after the failure of Lehman, even in scenarios which assumed declines in house prices that were as large or larger than what would actually happen, the macro models couldn't sustain an unemployment rate above 7%. And I had a similar experience, by the way, when I was the Council of Economic Advisors chairman for President Bush, and he asked us, we wanted to show him what would be the implications of a 30% drop in house prices without a financial crisis, and we found, a recession, but a modest one. So the house price decline was not by itself sufficient to generate the kind of recession that we saw. The other piece of evidence is from my own research. I just presented a paper at Brookings in September on the linkage between the crisis and the economy. And what I found was that indicators of the panic, such as the spread between the LIBOR rate and the short-term interest rate, the OIS rate, were much better forecasters of the real economy than were things like house prices. And essentially what I'm saying here is that that the timing of the crisis was tied very closely to the downturn. So obviously the worst of the decline in the economy was in the fall of 2008 after Lehman and AIG, and the economy began to recover in 2009 after the panic was controlled. The third point I would make is that because the panic was so central, certainly in the U.S. case, and I'm sure Jean-Claude will talk about the sovereign debt crisis in Europe, a somewhat different situation, but because that was so central in the U.S., I think that we have to evaluate the regulatory changes that have been undertaken since then, in terms, at least in part, in terms of how they guard us against a future panic. And I think, very briefly, and I'm sure we'll get into this more, I think that in terms of reducing the risk of a panic occurring, reducing the vulnerability of the system, I think we've made a lot of progress. Andrew Metrick, for example, and Rob Engel showed some indicators that suggest that those kinds of risks are lower. Certainly the shadow banking sector is smaller. The amount of reliance on short-term funding is down. All those things are encouraging, more capital, less leverage. I think, though, where I remain concerned is in terms of the firefighting tools. And I understand Tim Geithner talked about this yesterday. And talking specifically about central banks, I think that the lender of last resort tools, particularly at the Fed, and this is, I think, less the case Mervyn and Jean-Claude can comment, I think this is less the case outside the United States, but in the United States, the lending tools, the lender of last resort authorities of the Fed were constrained after the crisis, and I fear that they are not fully adequate. I am fairly encouraged by some of the developments in terms of the resolution authority, the liquidation authority, which I think will be very helpful, but the normal lender of last resort activity that the Fed undertook in the crisis has been constrained, and I will talk about that more, but I worry about that. So that's my perspective, that the panic was very central, and therefore that conditions to some extent what we did. Obviously, we were late in understanding that this was going to happen. It took us a while in 2007 to see the extent of the panic. Once we understood what it was, we reacted aggressively with lending and ultimately with capital and guarantees to help stabilize the system. I think we were successful in stabilizing the system. I think just to throw this out there as a conversation thing in terms of the politics and the communication, there's clearly what we did was very unpopular. Was that because of inadequate communication on our part? Was it because our political system was just not set up in a way to appropriately address these issues? Would it have been better if we'd had more pieces already in place before the crisis? That's what I actually think. I think that if we'd had something more like an FDIC for the shadow banking sector, we would have been much better placed, both economically and politically. But again, if I want to think back about where there could have been differences in terms of the response after the crisis began, I think the communication and the politics was certainly a much bigger part of it also than I initially understood, but I certainly quickly came to appreciate that.
Thanks very much, Ben. Mervyn, speaking from the mother of central banks.
Well, I share Ben's view that the essence of this was a run on short-term debt liabilities, and that the impact on the real economy derived from the existence of the run. And not just within a country. I think there was a global downturn, and it reflected really a change in narrative about how much confidence one could place in the US and therefore, by extension, other financial systems. But for me, there were three main lessons. And I think the question I'd want to add to Ben's two main points is, why was there a run in the first place? So for me, the first lesson was that the banking system was undercapitalized. The second lesson was that the lender of last resort framework that we thought we inherited from the past to extend emergency liquidity was inadequate to cope with a modern banking system. And the third lesson is about the politics of how to deal with these problems. So on the first one, I think certainly at the bank we felt pretty early on, by December 2007, January 2008, that the loss of confidence which markets showed in the banking system, as reflected in the waxing and waning of the LIBOR-OIS spread, was never going to be dealt with satisfactorily without a recapitalization of the banking system. And indeed, when the banking system was recapitalized, confidence in the banking system as such was restored. So I think that was a very important point. Now, the difficulty, of course, with that is that there is no objective measure of the amount of capital that you need in order to maintain confidence in the rest of the system to be willing to lend to banks. Before the crisis, we know people were willing to lend to banks at very high leverage ratios. And once the crisis had hit, almost no amount of equity capital would have sufficed to restore confidence. So capital requirements are a bit of a rough tool. They're important, but there's no objective measure, I think, on how much you need to put in place. But the system was undercapitalized relative to expectations at the time. The second issue on liquidity and lender of last resort, we all knew, Bagehot's dictum, lend freely at a penalty rate against good collateral. But all three aspects of that failed in 2008. The first one, lend freely, failed because of stigma. And I think we were not conscious of how important that was. We should have been, because I think the 1914 episode, the beginning of the First World War, major financial crisis, somewhat overshadowed by the actual First World War itself, but nevertheless it was a big financial crisis in which, in the run-up to it, stigma had played a role. And that was rather forgotten. And I remember, I think it was you, Stan, who brought back to my mind the words of one of my 19th century predecessors in coping with the crisis, which was we lent a great deal, and we were not over nice about it. In other words, you really had to force the liquidity onto the banks to make sure they would take it. And stigma was a big problem in designing facilities, and we heard about the facilities which the Fed invented. All of us were creating facilities to get around the problem of stigma. The penalty rate failed because it was time inconsistent. It's fine to say in advance you're going to impose a penalty rate. When you actually get to the crisis, the banks need the money. There's not much incentive to impose the penalty rate. And the third one, against good collateral, failed because there wasn't any good collateral. I remember when Royal Bank of Scotland failed, they rang up in the morning and said, we can't get to the end of the day. And I wrote out a cheque for £36 billion. And at the end of the day, I said to my staff, so what's the collateral we've taken against this loan? And they said, oh, it's mortgages. I said, yes. And whose mortgages? No idea. And the fact was that banks had run down, the moral hazard had kicked in, they'd run down their liquid assets virtually to nothing, and we were lending against highly illiquid collateral. So that framework didn't work. And I think we do need to redesign an ex-ante framework where the politicians sign off and give authority to the central bank in advance to conduct a lender of last resort operation. That's understood. They don't have to sign off on the particular actions that are taken. They can hold the Fed or everyone else accountable for those actions ex post. But there has to be an agreed framework. And I think it also has to be one in which we put in place some ability to ensure that there will be sufficient collateral. In my book, I talked about a scheme, pawnbroker for all seasons. I'm sure there are variants on it. I'm sure there are better ways of doing it. But some clear ex-ante framework, I think, will be needed to do it. And then lastly, on the politics, I was very struck that the crisis brought home the observation that banking is an industry that is closely intertwined with politics. The politics were toxic. People didn't, ordinary people didn't like the fact that banks were being, quote, bailed out, unquote. We had not sold to them in advance the idea that this lender of last resort provision could be seen as an insurance scheme because we'd not made the banks pay the insurance premium up front. That politicians had definitely been, whether the regulators were captured by bankers is a different question, but certainly the politicians were, without any question. And when it came to the realization that the banks needed recapitalizing, the banks themselves were the biggest obstacle to it. They fought tooth and nail to the end to prevent a recapitalization, and the politicians took the view, we must get through this crisis somehow, but we've got to do it with the agreement of the banks. There was a not sufficient willingness to say, this is a collective problem, and our job is now to impose this scheme on you. So, the hardest part of the crisis, without any doubt, I would say, was difficult coping with the substance of the run and devising schemes to handle it. But the worst part, the most difficult part, was actually trying to deal with the politicians. And maybe later we can have a discussion about the different political setups, because Jean-Claude had, was it 17 governments to deal with? At least I only had one. But everything that was done where politicians had knowledge of it somehow managed to be leaked to the press, which made actually conducting many of these operations extraordinarily difficult.
Thanks very much. Mervyn, on the word pawnbroker, said it a little quieter than the rest. I'm sure it was not intentional, but Mervyn has written a book called The End of Alchemy or something. Have I got that right?
Yes, The End of Alchemy.
The End of Alchemy, on what should be reformed in the British way of treating crises, financial crises, and he makes the role of the central bank to be the pawnbroker for all seasons, because the agreements about access to future credit from the central bank are made before any coming crisis. But if you want to speak about that in the second round, Mervyn,
Yeah, we can't come back to it, but
people would like this. Now, Jean-Claude, you have the hardest task because you had to deal with a crisis with your central banking laws not exactly complete and ready to go, and you had 17 members to deal with and so forth, and I wasn't quite sure how you did it, and perhaps you can explain.
Again, I don't think that the central bank had a lack of tools or instruments, frankly speaking, and nobody is envisaging to change the treaty and to change the statute of the bank. But let me go back to the start of the crisis. What was really striking, in my own understanding, is that when we met in Basel, several years before the crisis, and certainly more than 1 year, 2 years, say, before the crisis, even before the start of the subprime crisis, we were all convinced, I have to say, that the market was underassessing the risk premia generally, underassessing, if I may, the volume of the risk and the price of the risk. And that was shared largely by the banks themselves. I have the memory of a meeting we had, confidential, with the banks at the beginning of 2007, where clearly it was the conclusion. And even one of the bankers was saying, I know that what we do is bizarre, but when the music plays, I cannot help but standing up and
You
dancing.
have to dance. Yeah.
And it was an admirable summing up of the power of the market. When the market is going in some direction, that appears not to be optimal, even in the eyes of all the parties, at the highest level of the participants. Then we had the emergence of what I would call new properties of global finance, US finance certainly, but global finance also in the era of IT, generalized IT, and globalization. So the interconnectedness between all segments of the market, all institutions, all economies, was so large that this run, which had happened in the past several times, and we have a very good academic research on that, appeared to be very easy to constitute. If I may, the herd was forming up in a second, in a half day, in 1 day. And you could have changes and contagion to an extent that I have to say we could not, frankly speaking, foresee in advance, as you said, Ben. And I take it that it is something which is still there. We are still in this interconnection, and we have to prepare, if we have a trigger, to this kind of, I would say, behavior that is totally synchronized, like a laser, in market participants, institutions the world over, at least in the advanced economy, because in our case it was very much limited at the start to the advanced economy. So what I observed myself was at the time of the subprime, 9th of August 2007, because of a generalized sentiment in the world that there was a lack of dollar liquidity, an immense desire to borrow euros to swap them against dollar at a time when the New York market was not yet open. And we had no market the 9th of August in Europe. So we had to reflect on what to do when we had no market functioning. Had we let the market not functioning for one day, I think it would have created the sentiment that we were totally losing control. The ECB was totally losing control of everything. So we decided for the first time to give liquidity on an unlimited basis, and we were asked 95 billion. It was the sum of all the requests by all the banks that were eligible to our refinancing. We gave the 95 billion. They didn't need 95 billion, of course, but it was something which was a shock, I have to say. And then, of course, we managed to diminish day after day, because we had only lent this liquidity for one day with appropriate collateral, at least collateral what we trusted eligible to our refinancing. So that's one. Then, of course, when we had Lehman Brothers, the start of this period absolutely dramatic where there was a grave and immediate threat of collapse of the financial system, we also had to react extraordinarily rapidly. So what was absolutely amazing was the contagion, which was going by the half day. In comparison with 29, I'm speaking under your control, Ben, I think that you would have had the time lags totally different, much longer. But there, as a question of half days, not only in the US, but in Europe, we had the panic, contagious. And we had to react also very, very rapidly and swiftly. And I will always thank Ben, and I think that we share that view, for having accepted that we had an extension of the swap with the Federal Reserve in order to cope with this dollar liquidity, which was the major problem at the time. So my understanding, taking into account those two examples, was that we have to be prepared in this new world to cope with emerging properties of that kind that we have experienced in the last crisis, but other that could be experienced in next challenges. And we have to be fully aware that we have to respond extremely quickly and boldly. Had we asked the public authorities, the executive branches, to decide on what the central bank should have done at that time, when we were on the front line in Europe or in the US or in the UK, it seems to me that they would be absolutely incapable to decide. I'm sure in my own constituency, it was too bold. Even the 95 billion I mentioned in 2007, they could not decide something like that. I mean, it was absolutely impossible. And we could see in the US the difficulty to get the TARP program being voted by the Congress, which it was overdue. That program was overdue. But we could see that the political sphere, the political elite, could not yet understand how grave it was. So I would, en passant, say that it is a good reason to consider that independence of the central bank is very important, not only to defend against the short-term, I would say, pressure coming from the executive branch, but in some cases also to be able to cope with new unpredicted events that are extraordinarily dangerous. Now, as you said, Ben, I had not only to cope with the private sector drama of the crisis, the epicenter of which was in Wall Street. In our case, we had to cope also with the sovereign risk crisis. But let me only say, in concluding on this crisis of the private sector, that it was something quite extraordinary that we avoided any bankruptcy in the euro area of any systemic financial institution. I know by experience that it was not easy. We had at the time immediately 15 countries concerned, then 16 countries concerned, and all of them had to go through their own democratic process to see whether or not it was appropriate for the taxpayer risk to be put on the table. And I have had myself to convince a number of executive branches that, yes, indeed, we could not afford a new bankruptcy Lehman Brothers type in Europe. But again, we succeeded. And I think it has to be put to the credit of the system of the very exceptional and I would say the system of the executive branches having to respond to more or less the same challenge and responding in avoiding the catastrophe. And of course, the catastrophe was, the executive branches were challenged again by the sovereign risk crisis. I don't know whether you give me a little time to speak on the sovereign risk crisis.
I'm going to do a second round on this, fine. So it'll probably be there for you. The one of the most interesting aspects of this crisis in historical terms was the unbelievable speed of transmission to Asia. And within 2 months, I think exports and some of the leading exporters were down by 50%, which for export-rich economies was very powerful and very difficult for them to deal with. What was it that caused this incredible speed of transmission? And I'm going to start down the row, one further down the row each time. Mervyn, you start. Jean-Claude, you're next. Ben, you're the one after.
So I was very struck in the crisis that our central bank colleagues from not just Asia, but also Latin America, would ring up and basically say, we haven't had a banking crisis in our country, but nevertheless, we're seeing a dramatic drop off a cliff in domestic spending. Why is this happening? And I put this down to the fact that, as Jean-Claude said, and Ben too, before the crisis, we knew we were in an unsustainable position. Something had to give. What we didn't know was what and when we give. We had long discussions at the IMF about whether the US dollar would fall sharply as a means of correcting it. And deep down, we've been going through a period of a long period of just continually falling long-term real interest rates and compressed risk premia. None of this looked to be remotely sustainable. And there was a narrative out there, which in many countries was, the good times have been rolling, we can go on spending. When the news about the enormous financial crisis, the panic in the heart of the world's financial system in New York hit the world, I think people said, gosh, if it can happen there, it can happen anywhere. And maybe we too ought to be deeply shocked and worried by what is going on. I think there was a big change in narrative that people were using to persuade themselves of how they should think about their spending and planning and making investment. And there was a very big change. And I think that's supported by the fact that once you go just 6 to 9 months down the road after that, in most of the emerging market countries, people realized, well, actually, they hadn't had a banking crisis. They weren't so badly affected. It was the emerging market part of the world that started to lead the world economy out of recession.
Yeah. Jean-Claude, and your other topic, if you...
Yeah, my understanding is that, as Mervyn said, the emerging world and in whatever continent they were, had before their own crisis, so Latin America crisis, the African crisis, the Asian crisis, and they were obviously, we have to recognize that, in a much better macroeconomic and macro-financial situation than we were, because we had no such crisis and we had not to adjust ourselves. I have experienced myself the adjustment in many emerging countries as chairman of the Paris Club, and it's been really an enormous effort that they did to survive and surmount this dramatic crisis. So it was a little bit humiliating, by the way, for the advanced economy to be the epicenter of the last crisis that happened before in practically all continents in emerging economies. Of course, the advanced economy have an immense influence on the global economy, on global finance. Of course, they are the heart, as you said, Mervyn, of global finance, and economically on the rest of the world. The fact that a large deal of any investment in our own countries was interrupted because of the uncertainty of the situation, and the fact that everybody was trying to be as liquid as possible, as non-invested as possible everywhere, created for China, as you said, and for the rest of the world, of course, an immense impact, negative, which the channel of which was really going through trade and investment, in my understanding, and not necessarily through the domestic banks and domestic markets that resisted quite well in the circumstances. I conclude in saying that for us, I would say, the advanced economy, it has been really dramatic. Not only in our own countries, because the confidence that our own fellow citizens, our own people would have in the way they were managed has been eroded, as is clear, but also the baton was passed from the G7 to the G20, which was also a symbolic evolution, very telling in terms of, I would say, what the rest of the world was thinking of the way we had run altogether the situation.
Thanks. Ben, on the rest of the world and their role in the crisis, being a central bank governor in Israel at the time, was continually getting phone calls. Can you help us get swap lines from the Fed?
Sorry.
Which I thought was very bold of them, but I wasn't certain that I was the right address. Can you tell us how you thought about it and how you deal with that difficulty that people feel, well, everybody else gets it, why not us?
Well, I want to go back just one step and just say something about this fundamental question of how the crisis had the big effect on the economy. You hear this naive comment sometimes, well, how many firms in a given quarter are actually seeking new credit? You know, and those are the ones who were affected by this shock to credit supply. I think that's exactly the wrong way to think about it. I think what happened, as Mervyn and Jean-Claude were both indicating, is there was this massive surge of fear and liquidity preference, precautionary savings, the desire to husband liquidity. For example, firms that didn't have any immediate need for credit drew down their credit lines as far as they could just to have as much cash as possible. And so this created a tremendous impact on the real economy as firms, for example, stopped hiring because they wanted to conserve the costs of employment. So this had a global effect. I had the same experience. I had a visit to Brazil that was scheduled 2 weeks after Lehman, and they were going, we didn't have a crisis. What happened? All of a sudden, the economy stopped. You know, and it was because everyone, went into this deep fear, and that's again why I think the panic was so critical. Trade, in particular, trade is dominated by durable goods. There's a lot of trade credit, so all those things made it even worse. But trade was absolutely killed by the crisis. Now, on this question about dollars, I think if you're a serious student of the crisis, you need to understand that the institutional frameworks across countries were actually quite different in many ways. In some ways, the Federal Reserve was disadvantaged. The Federal Reserve has the most limited authorities in terms of what it can buy, who it can lend to. I mean, we were severely disadvantaged by the fact that we needed to invoke emergency powers to lend to anybody that wasn't a commercial bank. Whereas the ECB, could lend to any financial institution. So in some ways, the Fed was disadvantaged. But in one way, it was very asymmetric, was that we were the producers of dollars. And as the work of Guy Gopinath shows and many others, the dollar has, particularly in a period of intense crisis, is the key currency. And one of the first things that we did in 2007 was to set up ultimately 14 swap lines with foreign central banks, essentially making sure that the foreign central banks had access to dollars, which they could then on-lend on their own credit risk to their domestic financial institutions. We felt that was essential to stabilize dollar funding markets and therefore important for the US economy as well as for the global economy. There was a very difficult political question about who was to get these lines. Obviously, the ECB and the Bank of England and Bank of Japan, all those major advanced economies, Australia and so on, were eligible, and we worked with them. For emerging markets, it was tough because we wanted, there's political constraints. We wanted to be sure that we didn't take any significant credit risk. We wanted to make sure that it was going to be effective in terms of market depth. So we ended up lending to doing swaps with 4 emerging markets. I think Brazil, Mexico, Singapore, and Korea, I believe, were the 4. They were based on criteria of the extent of their depth of their market, their economic importance to the United States. We dissuaded many other applicants trying to be conservative about it, but again, we did in the end lend a large amount of money through those channels, and I think they were an important way in which the Fed, at least for a time, served as the central banker to the world, and we felt that was important again, not just for the global economy, but to create stability in U.S. money markets that we needed as well.
Can I add a sort of gloss on this, which is, it relates to something that Bob Merton yesterday stressed, which is trust. And the one thing that became very apparent in the crisis was that the major central banks, who work together closely on a range of things and meet each other, have real trust in each other, which does not depend on formal agreements. And here's the example. September the 11th, 2001. That evening and the next day, the New York Fed was in no position to extend dollar liquidity to the major British banks operating in New York. And we were in no position to offer dollar liquidity ourselves. Alan Greenspan was stuck in Europe. He couldn't get back. So Roger Ferguson, who was number 2, was in charge of the Fed in Washington. And the convention is that when you deal with another central bank, you deal with your opposite number. And for good reason, because you know them. So it wasn't Eddie George who rang the Fed. I, as deputy governor at the time, was asked to ring Roger Ferguson and say, could we have a swap line in dollars so that you give us the dollars, we can then lend dollars to our banks in London, which will tide them over their dollar needs. And we did that in a telephone conversation with no lawyers present in the conversation whatsoever, $30 billion swap. We unwound it a couple of weeks later on. The only basis on which that could have been done and worked was personal trust. And there are lots of examples in the central banking world where you see that. It would not happen, I think, between governments, because the lawyers would certainly be involved then. But it reflected the flexibility which central banks have to do a job and do what's necessary when you get a crisis that no one had anticipated.
Yep. Jean-Claude?
Yep.
We're done with that. Now, the next question is, and you'll start off, Jean-Claude, is what changes would you like in the regulatory system?
I thought you would ask me to say just one word on the sovereign risk crisis, which was
that's fine. Yes, please
maybe
do.
it's for
Maybe even 2 words, Jean-Claude.
2 words. But I respond first to the question you asked. It seems to me that we are still in a very dangerous world, obviously. I take it, and I was very impressed by the exposition here, that what we did for the banks in general has been quite well done. Maybe Mervyn will find that it is not sufficient, but I really take it that a lot has been done anyway. Still, there are part and parcel of the global financial system that seems to me still dangerous, obviously. The change of qualification of the non-banks or the shadow banking or whatever. I am not tranquil with that. What we said on runs, on herd behavior, is valid for markets as well as for banks, and the two, of course, are correlated. I am not very, very tranquil on the possibility of having, in this, space, very large space, which augmented quite considerably out of the banks, that we could have new challenges that would be very dangerous. Leverage has continued to augment. Public and private leverage has continued to augment after the crisis as it did before the crisis. And if you add up public debt outstanding plus private debt outstanding as a percentage of global GDP, you see, and the IMF produced recently a paper which was quite telling, suggesting that this indicator had augmented of something like 25% of the global GDP, plus 25% of global GDP, over a period which goes for, I'm speaking under the IMF people there, from perhaps, I would say 2007, 8, up to 2016. So more or less after the crisis. So this is something which signals, not necessarily in any particular country, but at the global level, that we are more vulnerable. Now, 2 words on the sovereign risk crisis. We had, of course, the contagion of the, I would say, private sector crisis, the epicenter of which was in the US, and we had the sad observation and experience that the epicenter was crossing the Atlantic, as you told me once, Ben, and that we had the epicenter of the sovereign risk crisis. I said the epicenter because some signs were given that the market participants, after having been dramatically shocked by what had happened in the private sector, private signature crisis, were, I would say, very skeptical as regards all possible signatures, including the public signature. Very fortunately, they considered that all taken into account, despite some kind of downgrading of some advanced economy signature, nevertheless, they could continue to trust them. Unfortunately, in the euro area, we had, at the beginning of the sovereign risk crisis, 3 of the worst signature in the eyes of the market in the advanced economy constituency, because we are an advanced economy grouping. And by the way, we had also more or less the 3 best signatures. So the euro area was stretched between its bad signature of states and treasuries and its good signature of states and treasury. I offer you that vision of the euro area because what everybody has in mind is that the euro area had a dramatic crisis. It's more complex than that. All taken together, 5 countries out of 19 today had a dramatic crisis. The others had not a dramatic crisis, and among the others, you had the best signature of the world. So it's also a clue to understand why the euro hold in this crisis, why the euro area hold in this crisis. You might know that we were 15 countries at the moment of Lehman Brothers, including Greece. The 15 are still there, and 4 new countries got in, so that we are 19 countries today in the euro area, which is, of course, symbolically an illustration of the resilience of the euro itself and of the euro area. That being said, it was a dramatic crisis, obviously, and the central bank did all what it could to cope with this crisis. I embarked myself on 3 very important moves, if I may. One was the full allotment at fixed rate that we generalized the 15th of October 2009 in order to be sure that absolutely all countries would have all the liquidity they were needed through the banks. And you know that the commercial banks were financing 75% of the economy of the euro area. 75. In comparison with the US, it was very, very high. In the US, the market, more or less, we are financing 75% of the US economy. So we try to put all our banks in a position where they could have all the liquidity they would ask for, provided, of course, they will have collateral. And then, as you know, we intervened on the markets. I'm only mentioning the important decisions in purchasing treasuries for Greece, Ireland, and Portugal in 10, and the treasuries of Spain and Italy in 11. it was the two peaks of the sovereign risk crisis. And then, of course, I left, and my successor took a number of other decisions. But we had there, and it is another illustration of the fact that from time to time you have to be prepared for things that are not necessarily expected, and prepare also to take decisions very rapidly. In both cases, the SMP program that we started, the decisions were taken in a weekend. We had to take the decision in a weekend, not to let the panic becoming totally systemic in the system. And we blocked the systemic destabilization of the system. We permitted those countries to have access to financing at a level of interest rates which was more reasonable than the very elevated spreads that were, I would say, practiced by the market. You probably have a very vivid memory of that because you were in Frankfurt, you came for a colloquium immediately after the first move, yes. which was striking everybody. I have to say a lot of public opinion also in Europe.
Thanks very much, Jean-Claude. Mervyn, I sort of wander around saying we should have a lender of last resort facility like the British, and they guarantee everybody somehow or the other. Could you sort of say something more exact than that, please?
Well, there are no limits on the identity of potential recipients of Bank of England support. We can lend to whomever we want, either in the financial sector or outside it. The only thing is that we now have an agreed memorandum of understanding between the bank and the Treasury on behalf of the government, which I signed with George Osborne, which sets down the fact that the Treasury has to give approval to any specific lender of last resort operation. And I think that's sensible because in the end, it's the Treasury that is going to underwrite the fiscal risk of engaging in that. And there have been a lot of attempts over time to say, well, we should maybe raise the Bank of England balance sheet so it could do some lender of last resort on its own account. And my predecessor was quite keen to have that. But actually, when you look at it, this is crazy because, frankly, the limit that anyone is ever going to agree for the bank to do on its own is so small that it won't have any impact in a systemic crisis. So in any systemic crisis where the lender of last resort really matters, it's inevitable, in my view, that you have to have a framework in which the political side of it gives agreement. It can do it in general terms ex ante, or it can do it by being involved in the particular operations. But in the end, they have to give the indemnity to the central bank for carrying out an operation. The nature of it, as I said, in the crisis, we saw serious weaknesses. I mean, I remember, for example, when we were first called upon to act as a lender of last resort, I said, well, just send down the files on how we set the penalty rate. Well, there weren't any files. So in 24 hours, we got some economists and we put together wasn't the back of the envelope, it was on quite a large number of pages, but we actually produced an argument, produced a penalty rate. But that was subject to time inconsistency. In the end, what was the point in imposing it? So I think that the system does need to be redesigned, and it needs to be redesigned something along the lines of my proposal in which you have to, the objective is to say that maturity transformation, whether it's in the formal banking system or outside it, is an important part of the credit process. We've not learned to live without it, which is why narrow banking is certainly not a feasible proposal at this stage. But nevertheless, if there's too much maturity transformation, then it can cause the risk of a crisis. And just as Ben said, it's the crisis, the panic, which can have enormously costly economic repercussions. So you want a positive tax on the degree of maturity transformation. That means looking at both the asset and the liability side of the balance sheet together. And one of the weaknesses of Basel all the way through has been that initially it focused only on the asset side. Interestingly, when the Basel process began in terms of regulation, way back when, long before I got anywhere near the Bank of England, the Bank of England did propose that the Basel process look at the liability side of the balance sheet, but that was dropped and never taken further forward. It's come back, but it's separate regulation for assets and liabilities. I think it needs to be integrated, and you can see my proposal essentially as make banks pay some kind of insurance premium in the form of pre-positioning collateral on which the central bank sets the haircuts, in order that they would be automatically eligible to borrow from the central bank sufficient money to cover their runnable liabilities. And it's the runnable liabilities that matter, which is why I have never really understood these wide definitions of what apparently used to be called shadow banking, which includes lots of institutions which have very small degrees of runnable liabilities. We need to focus on the elements that can generate a run. That's the essence of it, and that's what we don't have. So if you in your very beginning remarks, Stan, you said, well, what do we wish we'd done differently? And I think, as Ben indicated, what we would like to have done differently refers almost exclusively to things before the crisis, as we didn't have an ex-ante framework for this. We didn't have enough capital in the banking system. We didn't have a resolution process that would deal with bigger banks. Now, as Tim said yesterday, I think a resolution process is necessary but probably not sufficient to deal with a systemic crisis. But it was the framework of handling with it. And most important, we didn't have the political buy-in to saying, well, here's a crisis we have thought through in advance through how we might deal with it. And we're broadly comfortable with the framework that's being used. Everyone was sort of making things up as we went along. And that didn't give great confidence to the politicians that they could afford not to be involved. And they certainly wanted to be involved.
Can I?
Yes, please,
I'd like to, first, just one theme I'd like people to take away is the really substantial differences in the powers of different central banks. So Mervyn could lend to anybody, presumably including his gardener.
Well, I'll tell you a funny thing.
Yeah,
Parliament said, well, why don't you lend to small businesses?
Yeah, well, that's a risk,
right?
yeah.
And I said, no, that's fine. And they said, lend to small businesses, boost the economy. I said, I've got a really good small business I know I could lend to. I know it would boost consumer sentiment in the whole of the Midlands in Britain. Great idea, they said. Only thing is, I said, it's called Aston Villa Football Club, at which point they recoiled from this proposal and thought it was outrageous that I should even consider it.
Well, the Federal Reserve, is not only cannot lend to, except an extremis, cannot lend to an investment bank. De facto, its lending authority to ordinary commercial banks is much restricted because of the stigma and the various problems. But interestingly, so I think that there's a big difference there, and it's a concern to me that we don't have, in the United States, we don't have the lender of last resort authority that's adequate. Although, interestingly, there is one part of our system which actually works very well, which is the way the FDIC deals with failing commercial banks, particularly small to medium-sized banks. If a medium-sized bank in the United States fails, the FDIC comes in, it guarantees the liabilities, it puts in money if necessary, it finds a buyer or it sells the assets. It does all this very neatly with no political reaction whatsoever. This is totally normal because it's all planned in advance and there's a set of rules, and the Fed can stand by to lend if necessary, and it's all very, and together with a good resolution regime that wouldn't be a complete solution, but it's one approach that would I think be certainly a lot better than what we have. And so I think that one direction, it's ironic that the United States is the country where the Fed has the limited lending authority, but also has the biggest non-bank credit markets.
Yep.
So you asked earlier about directions for reform. I think one very constructive direction would be to think about how to extend both the benefits of the banking charter, including various kinds of insurance and access to the central bank, but also the restrictions, the capital and supervisory restrictions, and the ability of the FDIC or similar agency to intervene to any credit granting firm that relies significantly on short-term funding. So that's a direction I think that we ought to be talking about, and would just take us more in the direction of, I think, the British and European examples where these institutional features are not quite as extreme.
Jean-Claude, you want to add something?
Only to mention that in our case, which is very special, obviously, we have an institution which has a very high level of capital that we are owning ourselves. We are less depending, I guess, on the Treasury than in the UK or in the US. And we have the gold reserves. I mean, we have an enormous amount, of capital. That's the reason why we took a number of decisions in our own risk. And by the way, practically all what we did permitted us to make money out of it, because counter-speculating, when you win the counter-speculation, you win money. That's and you take care that the speculators are losing money, which is a very, very good thing, of course, for the future. On the nevertheless, when things are real big, I wrote messages and letters to the institution, and by the way, to all governments, in making them aware of the fact that in the crisis we were taking a high level of risk, and they have to understand that, because at the last resort, of course, the system is such that it is the central banks, the national central banks, that are the owner of the ECB, and if, which was absolutely not the case, I told you that we made money out of our intervention, but if we had risk that would be materializing for enormous amounts in the future, that could be possible, then of course the government would have to step in, but only after we would have used our own capital. A last point, if I may, we have not to, I know that it is the rule of the game here that we concentrate on rules, regulations, and I have to say that what worries me the most is that macroeconomic policies are not optimal in my own understanding the world over, certainly not optimal in the advanced economy, but also in the emerging economies. I take it that it is for that reason that we have the augmentation of leverage I already mentioned, and which is now understood as one of the major vulnerability of the global economy. And I think that we have there to do something, and in my opinion, it is quite urgent, because we have to change the balance between equity and debt in practically all economies, emerging or advanced.
Thanks. I'd like to turn to Mervyn on a question that Ben on a question that anybody who talks with policymakers in the United States, particularly on the right, has to think about very hard, and that is, how large should the role of moral hazard be in designing facilities? Because what you hear is, well, that will create moral hazard, and that is taken as killing a proposal, whereas in fact there's moral hazard in almost any insurance arrangement, and still we have insurance. But Ben, how much has that actually impeded anything that the Fed has wanted to get done?
Well, I think it's been, there philosophically, and I think there's this fear of moral hazard has led Congress sort of to say, well, we're not going to make any preparation for this contingency because we don't want to give the sense that we would in fact intervene. But of course, if things get bad enough, some future government will intervene, and so it's not a time, as Mervyn would say, it's not a time-consistent promise. So you're better off setting up an ex-ante structure, which number one lays out the rules and eliminates some of the uncertainty and delay and political costs and so on. Secondly, that is only relevant during a systemic crisis, and therefore, if you're an individual firm that's making bad decisions, that you're not going to be protected except in the event of a systemic crisis. And third, which imposes costs. I mean, I think it's, for the most part, it's a myth that American banks were, quote, bailed out and held harmless, during the crisis. It's true that creditors were protected, But the equity holders, the management, and so on were very badly hurt by even when their banks received capital, for example. So I think the answer to the question, I mean, you're absolutely right that concern leads American politicians to want to not to prepare in advance for whatever may happen. But it seems like the better approach would be, as I was saying before, is to have a structure in advance where you lay out the conditions on which there would be intervention, the terms on which that would happen, the rights of individual stakeholders in those circumstances, and ex ante restrictions and oversight that, as we do now with deposit insurance, for example, that would ex ante would limit some of the moral hazard problems. So I think it's a solvable problem.
It's encouraging because I know you don't exactly say things you don't believe, and I've heard that argument made, well, in the end, they're not going to let the economy collapse, so they'll do whatever. But if you believe it, I believe it more. I mean, not more than you, more than I used to. Mervyn, any comments on this issue? Has it been a factor in England?
So, I mean, for many years, central bankers would talk about, in the context of lender of last resort, constructive ambiguity. And
well, you set me straight on that issue.
Yeah, so I never found ambiguity very constructive. And I think one of the most important things to come out of this is the point that Ben has just made, which is it is very much better to set down a clear ex-ante framework within which operations can be conducted and the rules which will govern it. You then get political buy-in to it. The politicians don't have to say we agree with every individual action that's taken, and they can hold people accountable ex post, but the framework that's being used is laid down. And this, I think, is one of the right ways to go. It's why I put forward my pawnbroker scheme, and I'm sure there are other ways of doing it, but some clear ex-ante framework, I'm sure, is the right thing to do. And as any policy intervention design, it's, moral hazard is simply a general phrase, a very unfortunate phrase, because it has connotations that go well beyond the technical, namely that if you put in place a particular policy regime, people's behavior will respond to it. That's all it means, and so obviously you have to take that into account when you design it. So you've got to have a consideration of moral hazard when you design the scheme, but merely mentioning the word does not mean that you can't do something at all. But designing it in a proper ex-ante way, I think, is the right way to deal with these problems and the concerns that maybe have led to inaction.
Thanks. Jean-Claude, let me just mention, there's somebody who carries a microphone around here, and after Jean-Claude has made his statement, we'll turn to the audience for 3 or 4 questions, and they better be brief. Jean-Claude, please go ahead.
Well, I wanted to make a point, which is that the euro area is transforming itself under the pressure of the crisis. We had 2 new treaties. We reinforced a number of pillars for governance. And we had the banking union, which is a major, of course, structural reform, which was totally unexpected before the crisis, but was overdue at the light of the crisis, because the correlation between the creditworthiness of the banks and the creditworthiness of the nations concerned appeared very, very high. And if we want to combat next challenges, we have to try to detach the creditworthiness of the banks from the creditworthiness of the nation, which was one of the goals pursued by creating banking union, giving the central bank the responsibility of surveying the financial institutions and the banks, and creating also a special entity, which is not the central bank, for resolution, creating an insurance guarantee for deposit. All this is work in progress, very important at the light of all what we are discussing. And I have to say that the FDIC appears as the model, the role model for us in terms of dealing with small institutions. It's really a fantastic success of the United States.
Thanks very much. We've got a little time for One question, we'll have to take it on a geographically fair basis. We'll take one from that third, one from this third, and one from the third over there. But if none of you, well, you've just put your hand up. You got it, with a red shirt. Can you speak up, please? And the mic is about to reach you.
Hi, speak up and please identify your name.
Bob Swarup, Camdo Global. I am soft-spoken, so I apologize. The question I actually had for the audience, for the speakers, was about central bank independence. Because, I mean, the story I'm reminded of is that of Heinrich Goetz, who was the central banker in charge of the Riksbank in the late 18th century. And he holds the dubious distinction of being the only central banker to be beheaded for abusing public trust. And it was a victim of the fact that at the time, it was entirely a political decision because the government didn't want to take the responsibility of a crisis. And if you look at recent events, Donald Trump with Jerome Powell, Ed Balls in the Bank of England, to what extent can central bank independence actually be reiterated or preserved in an era of more kind of interventionist politics?
Okay, well, we'll take a random. We'll take the first of you to get your hand up. How about that? Well, none of you have raised your hand. So.
Jean-Claude, all
Jean-Claude.
yours.
Only to respond that in my case, of course, the situation is very simple. We have a treaty. The treaty is associating 19 countries and calls for full-fledged independence for the central bank. I myself experienced the full-fledged independence of the central bank, I have to say, and being protected by a treaty which will not be changed. Obviously, I already said that, of course, is in an extraordinary protection. And as I said, independence must function in both directions. Protect from the executive branches, be able to take bold decisions where absolutely needed, and when it's not obvious that the political sphere could decide. But at least it is our own experience in the ECB.
I think, can I
Sorry,
just
go
define,
ahead, of
it's
course.
important to define what independence means. It doesn't mean, for example, that the central bank can't coordinate or cooperate with the fiscal authorities, as we did during the crisis, which was appropriate. It also doesn't mean that the central bank gets to set its own objectives. In general, you know, the Congress tells the Fed to go for price stability and maximum employment, and in general, the government will give the powers and the framework. But it seems instrumentally valuable for central banks to have what's called Stan called instrument independence, the ability to set the interest rate in pursuit of those objectives. And I think, for what it's worth, I think the people who are at the Fed today are quite strong and independent and will continue to make decisions on that basis. So I'm not concerned about that.
Okay.
I think I have the right to speak. My name is Svi Bodhi, and Stan Fischer was my thesis advisor.
There's my grandfather there.
But he takes no responsibility for what I am about to say, which is that it's been very interesting listening to this discussion of the potential for systemic risk coming from the banking sector and the shadow banking sector. But I am convinced, after at least 35 years of studying the pension system, that that is where the next crisis is going to come from. And I'm even willing to go so far as to say what the first warning is going to be, and it will be the bankruptcy of the Pension Benefit Guaranty Corporation.
Well, thanks very much. I don't want to identify the person, but somebody once walked into my office and wanted to do a thesis on that point. And this was, I think, it wasn't you, at least as far as I can remember. It was somebody who's possibly even younger than you, Zvi. I thought this was, I was more naive then. I said they'll never have the capacity, the ability to do that. I mean, the political will to do that and so forth. I was probably wrong because they seem to have the political will to do lots of strange things these days. But that's it. We'll take that as given.
Can I just make one comment?
Oh, sure.
So it's very nice to see you, Zvi, after all these years. And I share your concern that there could be an economic crisis resulting across the world, actually, in terms of our inadequate pension provision. And we've made promises to people which the potential suppliers of pensions may not be able to meet. I think this is somewhat different in character to the financial system crises that we've been discussing, the runs, which the solution to which has to, I think, to come from central banks. But I think the question about pensions is a much wider issue. It's a very important one, I agree, but I think that one inevitably involves difficult political judgments and decisions, and that goes beyond our remit as central bank governors, independent though we may have been.
Thanks. Last question. Your hand was up first.
Thank you. Wilson Irvin from Credit Suisse. Ben, a few years back you testified that if the crisis had a single lesson, it is that too big to fail must be ended. And interestingly, just before you, Andrew Metrick said there's been almost zero academic work on this topic. I'd be curious as to both, do you still hold that view? How do you think we've made, how much progress do you think we've made in terms of attacking that problem? And why such a dearth of interest in the topic from academia?
Well, on the last question, you'll have to ask the academics, I guess. I'm now sort of 1 foot in each territory. I think some progress has been made. I think the most important, for a time-consistent failure, you have to make it plausible that you could have a failure that wouldn't bring down the system, right? And so that's the essence of the Orderly Liquidation Authority, the Title II of Dodd-Frank, the living wills, all of that. And I have to say, I've had a number of briefings from the FDIC and the Fed on the progress in that area, and I'm a little bit more optimistic about it than some. I think there are certainly it's certainly true that it hasn't been tested. Certainly true that it would not be easy, particularly for a large multinational firm with many overseers and so on. But I do feel that what's there is more credible, and that the living wills have led to more simplification and other important steps that would put us in a better position, certainly relative to where we were with the ad hoc weekend rescues of the crisis period. So I think some progress has been made. There has been a bit of academic research, including work by government academics like the GAO, for example, which have found that the funding advantage of large firms has been reduced, that the ratings agencies have downgraded the government support component of their bond ratings. So there is some evidence that we're going in that direction. But I certainly wouldn't claim that the problem is solved. But I think some progress has been made.
And isn't it true that there must be very few banks that are willing to go through this process as it was done in this last crisis? And they all...
Which process?
This process in which a lot of banks went bankrupt and were closed and were sold and were merged into other things and so forth, and people, the workers were leaving there with their boxes of possessions under their arm and so forth. It seems to me that if I was running a bank, which fortunately I'm not, I wouldn't particularly want to get into that.
No, that's what I was saying, that why the moral hazard concern is somewhat overstated, but also at the same time, think about if you really can't allow a large firm to fail, then you're in this situation where, in a crisis, every large firm is a potential time bomb, and extraordinary, politically unpopular and economically undesirable steps have to be taken to protect them. So I think that an orderly, I'm not being arguing that the market, free laissez-faire is the right thing. I think it needs to be a guided and organized failure, but I think it can be done in a way that at least reduces the implications for the broader system.
Okay, Mervyn, I'll give you each of you a 1 or 2 minute final
Okay, so
something.
I agree with Ben on that, and I think we are in a better position. Banks do have more loss-absorbing capacity. A byproduct of QE is that the system as a whole has a lot more liquidity than before, which is why I'll be cautious about the speed at which we run down central bank balance sheets. Resolution has been improved everywhere. That's a great help. My big worry would be that we are still in a position in which, if Goldman Sachs were to ring up one day and say, terribly sorry chaps, we've gone bust and we can't carry on, that the resolution framework, which, on paper might work smoothly, would maybe not survive the interest of the White House or number 10 Downing Street or someone in the European Commission, and that politicians would try to intervene because they would say, none of us really know the possible contagion effect of allowing a large institution to go through this resolution process. That would indeed be true. And the risk that that contagion might lead to further institutions requiring resolution, and it's impossible to resolve the entire system in that way, would lead to the need for an overall systemic response. Now, if we have a proper ex-ante framework for central banks dealing with that, then I think the risk of that is much diminished. But that's what I think that, what I take away from this is the complementarity between the efforts that have been made to increase the amount of capital in banks, to improve the liquidity position, though, as I said, more needs to be done on that front, and on the resolution framework, and on the international cooperation between central banks and regulators, all of whom are now conscious of the problems that can arise and the dramatic nature of the and the economic consequences of a collapse of the financial system. Now, the trouble is, much of this will fade as people age and younger people come in to run institutions who don't remember the crisis. But that's why putting things down and having an ex-ante framework is important.
Thanks very much, Mervyn. Last word, Jean-Claude, brief.
I said already that I was quite worrying when I look at some indicators of fragility at the global level and at the level of many countries. I would say one major difficulty I see for some central banks, and maybe all central banks of the advanced economy, in case we have a recession, or in case we have to cope with something which would have been triggered by, any kind of dramatic events, economic, financial, correction in asset markets that would be very, very big, then what would be the ammunitions? And that is really something which seems to me quite worrying, obviously, and certainly in my own continent, if I may. And it is also something which correlated with the lack of ammunition on the fiscal side in many countries also is a real issue that we should work on. I don't see easy solution, and I would not suggest changes in monetary policy or acceleration of going back to more normal situation, but we have to be fully aware of the fact that we will have to utilize ammunitions, and that they are very meager at the moment I'm speaking, and probably at the moment where the challenge will come and the difficulty will come.
Let me thank you, all three of you. I hope you realize what these three people and their colleagues in the same job in other countries achieved. When this financial crisis began, I think there was a genuine fear among many people who'd studied history and so forth that we were heading for a second Great Depression. And I think that belief was quite common among people, older people who knew what had happened in the Great Depression. I remember arguing with somebody who came to visit me at the Bank of Israel to explain to me that we were doomed. And I explained that we actually knew how to deal with these crises, which he thought was a joke. We did deal with this crisis. The cost of this very difficult crisis was much less than the Great Depression. Unemployment rate reached 10%, it reached 25% in the Great Depression. That's enough to tell you this was a very successful operation. If that was what would have happened, and my guess is for sure the unemployment rate would have been higher, if we hadn't carried out the programs that were carried out. And we were very lucky to have Ben and Mervyn and Jean-Claude and a lot of their colleagues in position to deal with this crisis when it came. We all owe them a lot, and I think we should give them applause, which relates not only to what they've said during this session, but also to what they've done in their previous job. Thank you very much.
Thank you, Stanley.